renting versus buying for wealth creation. Surprising results as to who ends up financially better off.
More often than not, over a 10-year period, the renter comes off financially better off.
Okay, so age-old question, $64 million question as to whether it's better to buy your property or save your money, put it somewhere else, into something else, and rent. Ernst Young, EY, reckon they've done the numbers for us. We'll see what numbers and what conclusion they've come up with. And then I'll tell you what I think and why I think they have started to calculate this. I mean, these numbers were always there. They could have done this all along, but they chose to do it now on the, what is it, 16th of October 2019, or just a few days prior to that. In any case, they've decided to release their findings now.
So, should you rent or buy to ensure a comfortable retirement? Realising the Australian dream of owning a home has been seen as a surefire way of creating wealth. But one of the big four accounting firms has crunched the numbers and says in some cases renters will be better off. Here's Andrew Robertson.
It's the well-worn path to wealth.
All sold, congratulations, ma'am.
Owning your own home. But as house prices continue to skyrocket, renting may be a surprising path to a comfortable retirement.
Well, I simply did the arithmetic to work out how you might approach retirement being either an owner or a renter.
And what businessman Phil Riven found with his arithmetic surprised him. For him, renting was a no-brainer.
You'd retire on something like 3 times the amount of money that a person who owned a home would if you rented or leased a home for most of your life.
Phil Riven has rented for 30 years and says the difference between his rent payments and what a mortgage would have cost has allowed him to plough $1 million into building his business into an international company. Big Four accounting firm EY undertook a detailed study of renting versus buying and reached a similar conclusion.
More often than not, over a 10-year period, the renter comes off financially better off.
What prompted EY to study renting versus buying was pressure from its large millennial workforce who were struggling to get the money together for their first homes.
We really wanted to question what we found was quite a wide-held belief that renting is dead money and that the only way to get ahead is to buy a property.
Prices are on the rise again after 3 interest rate cuts this year, with Sydney's median price pushing $900,000. That's well ahead of Canberra in second place, with Melbourne the third most expensive. Even in the cheaper capital cities, you'll still need around $500,000 if you want a place to call your own. EY's study focused on suburbs in Sydney that are traditionally in high demand by renters. It found that depending on the renting timeframes, renters could be up to $600,000 better off. But to get that money, there are some big assumptions.
Our renter also had saved the equivalent deposit, that they rented where they could afford to buy, they invested in a leveraged share portfolio, and they also maintained quite a stringent saving plan.
For those who advocate home ownership, there's a number of issues there. One of them is that a mortgage forces you to save, while if you're renting, saving is optional.
Other things come along the way, say a trip, new car, that can mean you don't end up wealthier based on that scenario.
Then there's the leveraged share portfolio which renters need to generate the income to get ahead. Margin loans are extremely risky, as was demonstrated during the global financial crisis when thousands of people had their investments wiped out. And there are many who believe that the current overvalued share market is headed for a big correction in the next few years.
We acknowledge that that may be a risk profile that many are uncomfortable with.
Most of us feel a bit more comfortable if we have a diversified wealth structure. Yes, it can include some shares, maybe via our super, but also owns a physical asset that you can touch it, you can feel it.
Casting a big shadow over the rent versus buy debate is retirement, where studies consistently show that rent puts a big hole in living standards.
You can buy a home and still have heaps left over to live very, very comfortably if you've rented for 20 or 30 years like I did.
Maybe, but like all investment decisions, if you're going to rent long term rather than buy, you should seek good professional advice. The quality of your retirement may depend on it.
Okay, so there are many assumptions there. They assume that the money that you would normally put towards a deposit for your property, you were going to save hard. You're going to actually, I think, borrow money to buy shares, so have a share portfolio. And with all those assumptions, renting comes out on top, which most people probably wouldn't stick to those assumptions. However, why EY is coming up with this now is not because the workforce is increasingly unable to buy and afford to buy a property. It's more to do, in my opinion, with big financials, banks, realizing that people are starting to question the validity of the belief that you need to own, you need to get onto the property ladder, otherwise you'll miss out. I think people are losing confidence in that notion, and young people are thinking, I either am not going to buy it ever, or I'm going to wait until it drops from these really high, crazy prices down to something more affordable, and then I'll go ahead and get into it. What these big financials are doing, I think, at the moment is that they're realizing that if you have 20, 30, $50,000, you can't even put it towards a deposit in capital city, Sydney, Melbourne, definitely. But what you can do with 20, 30, 40, 50, $100,000, you can invest it into the stock market and uh, play a bit of a casino, or maybe do it the right way, whatever the right way is. In any case, you put the money in there, and over time, it's been shown that giving a long enough time frame, you should come out on top, given also the rich dividends that Australian stock market offers. That could be the option. So now, remember how this property bubble got inflated by cheap credit, and everybody shoving their money deposits towards getting a mortgage and then buying a house, meaning that the bubbles are created. If you remember one of my earlier videos, they're created by retail people, mums and dads, us, buying or plowing into something, some asset class, whether it be property or tulips, or as such was the case in the 1600s in Holland. Look it up, tulip mania. Or dot-com bubble, where ordinary people opened up brokerage accounts online and started playing stock market, and they thought they were so smart because the whole market was going up, and they were buying whatever you bought in the dot-com sector. It ended up being valued more the next day, the next month, the next year. So again, you were so smart. I mean, does that resemble everybody plowing into the property and making money and thinking how smart they were to get in? Well, if the next wave of this money that people have, lying around, whatever it is, as little as 10,000 or more, and they think, well, that's nowhere near enough to put down the deposit. I'm just going to go and try and play the stock market. If all that money ends up in the stock market, what do you think that's going to do to it? That could be the next bubble. And maybe that's what the EY and the big financials are seeing, which is why they're now propagating idea. Look, don't worry about putting it into the housing, just whatever money you have, maybe have the margin loan as well if you can, so leverage and get into the stock market, because that's the next best thing. So my prediction will be, and it has been for a little while, is that the stock market will be the best place to put the money, because I see a lot of comments saying, okay, so you're saying don't buy property. That's kind of a no-brainer, to be honest, at this time, in my opinion. Not financial advice. Start looking around. If you haven't opened a brokerage account, just go and get a comsec.com.au or one of the others. It's pretty easy to do, and get used to the idea of buying shares. Look around, maybe subscribe to some newsletters, follow some of the YouTube channels, get some trading ideas, and just get your feet wet with small amounts and see how you go. I personally think that, and I've done the research that current stock market's actually not overvalued; it's fairly valued. But myself being what they call a value investor is and bargain hunter is that I'd like to buy something that's undervalued, not fairly valued, because fairly valued can still drop. It can go up into overvalued territory, but I think it'll probably pull back a little bit. As a knee-jerk reaction to some external event like the trade war, the Brexit, maybe a hot war. So when it's looking like there's no hope for the stock market and the world is in a completely different area and in a mess, that's when you start thinking and slowly getting into the market, in my opinion. That's what I'm kind of planning to do, but we'll see how we go. So why did EY look into this now at this stage in October 2019, whether it's better to rent or buy?
What prompted EY to study renting versus buying was pressure from its large millennial workforce who were struggling to get the money together for their first homes.
We really wanted to question what we found was quite a wide-held belief that renting is dead money and that the only way to get ahead is to buy a property.
So they wanted to question it. Now, my question is why? So I want you to question that as well and think about it yourself.